Chrissy. I'm here for Mortgage Mondays, and I'm sitting outside of Chandler City Hall with Jake Taylor at Pilot Mortgage. Say hi.
Hello, good morning.
So we're here to talk about some more first-time homebuyer tips, and I brought Jake over, and he's going to answer some of our questions. So, ready?
I'm ready.
Okay. So our first question is, what are 3 things you would tell first-time homebuyers?
You know, that's kind of a loaded question because if I could, I'd tell first-time homebuyers probably about 30 things. So I would say, you know, picking from the list, the number one thing that I would recommend right off the bat is this. If you're going to consider buying a house in the next 12 months, you should apply today or tomorrow, because on the loan application, when you fill out a loan application with a mortgage lender, the lender's looking for some variables that transcend more than 12 months, 24 months in a lot of cases. For example, Chrissy, let me ask you this. Let me put you on the spot for a second. I see in your Instagram posts and your Facebook posts that you like to do distance races, right?
Yes.
You run 5Ks, 10Ks.
Yes.
What's the longest race that you've ever done?
Half marathon.
Half marathon. Okay, that used to be my favorite race when I was younger. But would you say that if you showed up on the day of a half marathon, not having trained, and you tried to run the half marathon, would you get discouraged about 2 miles in?
I sure would. I would stop.
It would stop, right?
Yeah.
So I would say that discouragement that a lot of people face when they go to apply for a mortgage and realize, oh my gosh, there's a daunting list of things that I should have done before I applied. That holds people back from taking the mortgage application process to fruition. So if the time to apply for a mortgage is now, so that you have 6 months or a year to meet those guidelines, and you don't want to apply for a mortgage for the first time after you've gone to look for a house with a real estate agent to go, oh my gosh, I love this house, now I need to get a loan, and oh, I should have started long ago. So.
Yep, and what we see with that is if you apply for a loan after you find the house is under contract and it's probably gone. So
in today's real estate market, that is the case for sure. So even if you don't plan on buying a house for 6 months or a year, find someone that you feel like you can communicate well with, who's a mortgage professional, and fill out an application and start the ball rolling. That's my first tip for the day.
So that's tip 1. What's tip 2?
Okay, so tip 2 is this. A mortgage is not just a mortgage. What that means is that there are actually 4 major types of mortgages that you can apply and be qualified for. And those 4 mortgage types or mortgage products you may have heard referred to as a conventional loan, or an FHA loan, or a VA loan, or a USDA loan. And each one of those 4 different loan types has a very unique set of loan requirements and loan conditions that are unique to that loan program type or that loan name, USDA, FHA, VA, or conventional. So those different mortgage products or mortgage types are designed to help people of different socioeconomic backgrounds meet the variables that the lenders require, such as the down payment and credit requirements. So a mortgage just isn't a mortgage. There are 4 different loan types, and the more you understand those loan types based on where you're buying, how much money you make, and what your credit score is going to help you be a more empowered buyer as you go through the home buying process. Because the more you understand about the programs, the more options that are open, and the better you can make that decision and how to finance your home.
Perfect. Great tip. And what is your last tip?
Okay, so the last tip I have today is this. You really need to understand the difference between down payment and closing costs. So what is a down payment? Let's just say for example, you want to buy a condo in Tempe for $200,000, and the down payment is 3%. So out of $200,000 for a particular loan, you need to make a $6,000 down payment, which is 3% of the purchase price. So not only do you need to make a down payment, which will obviously be applied towards the price of the home, but there are closing costs required that you also have to be prepared for it. So what are closing costs? closing costs are fees and prepaid expenses that need to be paid to the title company, to the appraiser, to the government in the form of taxes, to the insurance company to protect your house against fire damage and flood damage. These are all kind of unforeseen costs that creep up on you like right at the last minute if you're not prepared for them, and kind of hit you with the shocker like, oh my gosh, I was ready for my down payment, but I am not ready for those closing costs. At Pilot Mortgage, our closing costs are, as the industry is concerned, very inexpensive. Our closing costs range typically anywhere between $500 and $800. Then of course you still have to pay an appraisal fee, which is between $400 and $600. And there are title fees that could be, depending on your purchase price, a couple $1,000s. And then you need to put money into an escrow account so that the lender can pay your taxes and insurance as they come due. So as you look at those closing costs as a whole, they can be upwards of $4,000, $5,000, $6,000, sometimes $7,000 if you're buying a house in the $400,000 or $500,000 range. So you need to be prepared for those costs as well. At Pilot Mortgage, not only do we have low lender fees, but a lot of the loan products, again, there's that word, loan products, FHA, conventional VA, or USDA, we offer lender credits to help pay for those costs that are charged by the title company that you put into your escrow account. So we can help you with those costs and credit, those costs that you may or may not have planned for.
Perfect. So that kind of leads me into my next question, which was, what programs do you offer? I think you touched on some of them, but is there anything else?
So the four main types of loan programs that we offer are the USDA loan, which is a 100% no money down program, but has very rigid geographic and income specific requirements, meaning you can't use the USDA loan to buy in Phoenix, but you can use it to buy in Santan Valley or in a rural part of Arizona. So that's a really cool loan program that a lot of people don't know about, but it's 100% financing, no money down, and we can offer lender credits to help you pay for closing costs on those loans. The VA loan, also a wonderful loan for veterans. I'm a veteran myself. I know the VA loan program very well. It's very liberal when it comes to credit requirements, income requirements, and documentation. We help many veterans on a monthly basis to get into homes with no money down and also enough lender credits to cover most of the closing costs in those situations. So I would say the FHA loan, the USDA loan, the VA loan, and conventional loan, although everybody offers those programs, we offer them we try to be very affordable in the pricing that we charge and the credits that we offer to our borrowers. But more than anything, I would say, because I've been in the business for 18 years and because I like to help people, that's just kind of my personality. I would say what I would offer to your buyers is honesty and responsiveness. So that's what I would say.
So perfect. That was actually my last question. Why should people work with you? So we've got that, and I know also Jake brought a list for us of things not to do. I know we have a list of things to do and tips for everyone, but he brought me a list of things not to do, so he's going to go over that real quick.
Okay, so these are 6 things that you don't want to do as you're applying for a loan. Number 1, don't make major purchases like furniture, appliances, jewelry, an RV, a new car, things like this. Don't do that before you apply for a loan. Don't change or quit your job. Your 2-year job requirement is paramount to being approved for all of those loan programs. And there are instances where there are some exceptions, but don't quit your day job. Number 3, consult with your mortgage professional before withdrawing money, before transferring money in or out of your bank statement, because once you begin the application process, the underwriter is going to look at everything that happened 2 months prior to your application and say, show me your bank statements for the last 2 months, not from today moving forward, but 2 months into the past. Don't pay off debt or collection accounts before you have your credit pulled. Why? Because once you pay off old collection accounts, that appears to be an admission of guilt by the credit companies, and once you pay off those old credit negative accounts, the full weight of that impact hits your credit score, and your credit score actually drops. So I'm not saying don't pay them off moving forward, but as you apply for the loan, make sure you talk to your mortgage professional about handling those debts before you do that. Number 5, avoid using cash for a down payment. Escrow deposit. The lender is going to want to know exactly how you got the money into the escrow account, so be prepared to document, source, and season those funds into the title company as you make the purchase. And last but not least, don't have your credit report pulled too many times. What's too many times? More than 3 or 4. Because if you have your credit pulled more than 3 or 4 times over a 2-week period, then the credit companies see that as you're not getting approved for the loan you want, and you're looking for something that's better, that's probably not available. So number 6, don't have your credit pulled too many times.
Perfect. Well, thank you, Jake. I'm going to post those shortly. I have a paper, I have a flyer. I'm going to post those down below, and I'm going to post a link to Jake's website so you can check him out, see what he offers, and applications right on the website, right, Jake?
Thanks so much for your time, Chrissy.
Thank you, guys.